Hello ladies and gentlemen, and welcome to my finance and accounting education channel here on YouTube. My name is Alex Petrescu, and today we are going forward with my mini series about the basics of personal finance. We have already spoken about so many things, just a short recap of all the topics that we have gone through in the past weeks. First, it was building a personal budget with the help of Excel and of a bank statement. I told you back then you can also do it if you don't have a bank statement, if you are working cash based, but it will be more difficult to remember all the transactions. And also you can use a piece of paper and a pencil, no need for technology. Technology is just facilitating everything. Then we talk about how to get rid of debt, then moving from debt to wealth. So that would be the natural development of things. Then we have talked about how to invest for beginners, how to invest $1,000 or euros, how to invest $10,000 or euros. Then we talked about how to evaluate an investment, and I introduced you another, let's say, template after the one for personal budget. I introduced you another template or another spreadsheet in Excel, for which I think you can calculate, and I'm trying to show to you with every following episode. You can evaluate your investment no matter how complex it is, because somehow the template is structured so that it can cover any type of investment and the potential gains an investment is bringing. After we have somehow built this template together, we started with talking about specific classes of assets. I skipped let's say, the bank deposits and the bonds because they are very easy. I jumped directly to the investment funds, also known as mutual funds, exchange traded or non-exchange traded, and all the specificities that come together with them. For this class of assets, we haven't used this template because it's also not very difficult. Let's say that the mathematics behind are not so complex that you need a special template to evaluate your investment. However, with the let's say also with this episode and with the episode that we had before we have started using the template, the previous episode was focusing on how to invest in stocks or in the shares market, and you already have there, you can have an initial investment, you can have additional investment. So in case the stock is going down and you decide to buy the dip, you can have sell of shares in the meantime if you want if you need some money, or you need to simply take advantage of some sudden increases of prices in market, and you just want to let's say to size some of your profit. And then also you can have a current period, or in the current moment, or at any given point in time, you can have a total sale. You can have dividends, taxes related to dividends, and also to sales. You can have all sorts of commissions and fees, and so it's already a little bit more complex to judge this kind of investment. And today we are going to talk about how to invest in life insurance with cash value or surrender value. I already have I'm saying it's investment with other benefits. Actually, the benefits come with investment, let's say, and I already have a point about using this word investments, and you will see it's immediately we are talking about a disclaimer when it comes to life insurance, because the things are a little bit more complex. I'm saying the first topic is giving up on returns for protection. The idea is that, of course, do not expect major gains from such a life insurance policy, because the purpose is not to deliver you investment gains. It's actually the other way around. You are doing this policy, so you are paying for this policy in order to protect yourself and your loved one against some risk, and you have on site some investment. I'm saying that there is a disclaimer here that in the United States it's technically illegal for a life insurance policy to market itself as an investment vehicle. This is according to Investopedia, and yeah, it's quite clear why, because it's not really an investment. The idea is that besides offering protection against unwanted events, mostly death or accidents, you will have this investing component, meaning that at the end of the duration of your policy, you might also get a sum. Yeah. Although maybe the risk don't happen, so you don't die or you don't have an accident which is preventing you from working or things like this. From thinking perspective and from decision making perspective, the first point and the absolute important point when choosing a life insurance policy is whether you have loved ones which are depending on you. So you need to assess, and this is specific to each individual, so I don't expect me to tell you if you need a life insurance policy or not. If you have a spouse that it's not working, or it's making or is gaining far less than you are gaining, if you have kids, if you have elderly person that you need to take care of, grandmothers, grandfathers, aunts, uncles, and so on and so forth, it might be a good idea to protect yourself, meaning that in case an unexpected and unwanted event happens, I said usually these two are, you either have an accident and you can no longer work, or you even die, they receive some money, and they can, at least for a certain period, they can have a normal life after the unhappy accident happens. The idea is that you somehow need to find a compromise between this investment component that you get and the coverage that the policy is offering you. Of course, if there is a policy that offers you absolutely no investment component, maybe you should think twice if that's a good thing for you, because that means that you are just covering for the risk and there is no investment associated to it. Now, into the technical details, usually they come with very long term, so they are like investment plans without being investments. 20, 25, 30 years, it depends. You need to make regular payments usually, so no lump sum at the beginning and then nothing or things like this. So regular payments, monthly, quarterly, and so on and so forth. The idea is that you need to stay in the program till the end. So it's really like I'm considering that somebody who's really entering into something like that needs to have a very strong financial discipline. Of course, if you get into troubles or for temporary situations, probably you can stop the payments. That is not very good. It's not a very good idea. And also withdrawing is not a very good idea, and we will see immediately why. And also the insurance company wants you to stay in, because that's the point of the entire endeavor, let's say. The cash or the surrender value is the value you get for the investment part of your policy, either if you decide at some point to withdraw from the policy or at the end. And you might already think about this like it's a bad investment, and we will see later that usually it's offering a negative NPV, which is quite normal. But think that you have some other insurance policies. You have this third-party liability. So for the third-party liability for your auto, you might have a casco insurance against theft, destruction, and so on and so forth. You might have a home insurance. You might have traveling insurance. There are so many types of insurances, and think that you are paying something, and if the risk, so if the insured event doesn't happen, so the negative event against which you are insured doesn't happen, you get nothing at the end. So think this investment more like a bonus to having your life insured and protecting the loved ones. Why I was saying that the insurance company and also you is trying to convince you to stay as much as possible in the program, is we have here a graph with the, let's say with the blue line, you have the cash redemption value. This is actually a policy, my policy. I have this life insurance policy. It's on 20 years, and this cash redemption value is with the blue line. The idea is that, for example, in the first 2 years I get nothing if I withdraw, and then the redemption starts to grow. And what is very interesting is, if you look at the year 20, is that I am actually getting 1.10, meaning that I get a premium. So my life insurance policy has a value at the end, and to that I get a 10% premium if I am patient enough and I do what I need to do till this anniversary of these 20 years. With the purple, you have premium to date as percentage from total premium that needs to be paid. For example, if you look in the year 10, you will get only 29% of the cash value, so this end value, but you will have to pay already you have paid already 43% of the total payments which you need to do, so of all the premiums that you need to pay. And you see this purple line is always above the blue one, except at the end when they somehow meet, and that means that you have paid 100% of your premiums and you get 110% actually in this case of the agreed cash value. Also with the yellow line you have the payments or the premiums that you pay. In my case I pay quarterly, and it's getting indexed every year, so of each 4 quarters with 3%. We will see that it's actually getting indexed with 2.97. I think it might be a rounding error, or their system somehow they are not working exactly with 3%, but 2.97 I don't mind. And the idea is that you start with 1 and you end up paying 1.75 of your initial premium. So so with 75% more than you are paying in the first year, so in the first 4 quarters. In my case, for this policy of mine. Then we have the template, which I have already presented to you, and we used already for evaluating a stock investment, so buying a share and many things that can happen around that specific security. And we are going to do something which I call a pre-valuation and a post-valuation. Actually, it's not a post-valuation because the policy is not at the end of the life, so these 20 years have not gone by. Actually, there are exactly 14 years, so it's something like an evaluation in the middle of the policy, a little bit later than the midterm. But the idea is, how can we use this template, which you have already seen, A as a theoretical example, B as to evaluate a stock, and now we are using it to evaluate this investment component of a life insurance. I told you that the policy is on 20 years and the payments are quarterly, which means that I actually had to have here 80 periods, which I have in Excel, but because of the presentation constraints I cannot present you here 80 periods. I have chosen to present you from 4 to the next 4 periods, because that's when the index of the indexation of the premium happens, meaning that, for example, if you look in the period 1, you have 819.4, and then plus 3% in the period 5. So basically in the period 1 to 4 I'm paying the same premium, and then starting with period 5 I'm paying 844 for the next 4 periods, so period 5 to 8, and so on and so forth, and I'm reaching and at the end I haven't gotten the first period of the last 4. I got exactly the last, because we can also see the positive cash flows. The idea is that if you are dividing 1436.8, which is the premium which I need to pay quarterly in the 20th year of my insurance, by 819 you will get exactly this 1.75. Besides the premiums, which are quite clear, you need to pay them quarterly, they get indexed after 1 year and so on. I'm also modeling here the positive cash flow. I put the premiums first on regular expenses one. I could have put them on also on regular investments. So it's absolutely of no importance. If you remember, we are adding everything which is on a column. It doesn't really matter where we are exactly on which line we are putting this. The idea is to have these cash flows as correct as possible. And for the positive cash flow 1 and 2, so I'm getting this cash value or this surrender value, and 10% which is already paid. I put them separately so that they are clearly there and so on. Then, because the premiums are getting 3% indexation over year, for quarter I have chosen, it's actually 0.75 discount factor. Because of one decimal, it's actually rounded, it looks like it's rounded to 0.8. So because 3% per year divided by 4, it's 0.75, and I have chosen as a discount factor, as let's say as not desired, as expected inflation rate, an average of 3%. And we will see how that played in the reality till the 14th year of my policy. And then you have the discounted cash flow compound. I remember for the first period we are not using anything. In case of net present value calculation, we will not discount the first cash flow. But then for the second period, we are already compounding the discount factors. Remember, actually this is the fifth one, so we have to compound period 1 to period 4 to get to this 3% and so on and so forth. Till the period 80 we have accumulated estimated inflation used as discount factor of 80.5%. Then we are dividing the total cash flows. The total cash flows, remember, are the sum of all the cash flows in one period. We are dividing them by this, by 1 plus compound discount factor minus, actually not as a percentage, and you get these discounted cash flows. Of course, the first one is the same, 819.4, and from the 89,863 positive cash flow in the period 80, in current values, you are actually getting only a 49,799.2 thousand. Because 89 will get discounted, so you will have to divide it by 1.805, yeah, so, or by 180%, 0.5, yeah. And just as expected, the net present value is minus 14,000. I will clarify later how to use it or what is the significance. It's the same with the net future value. Just remember that you need to compound this inflated factor. You are compounding it from the future towards past, let's say, and more or less is the same thing. You end up in the period 1 with an inflationary factor of 80.5%. Which means that you need to multiply the cash flow from the first period, 809.4, with minus times 1.80.5, it will be 1,478.6. And the net future value is 25,308.4. I told you it's a loss, of course, because somehow the company is using the money that it's getting from you not only to give you this money at the end, but it also needs to pay the people that have unfortunate events from all the pool of insured people. It needs to pay the premium, the amounts for which they are insured. Yeah, so that's why basically, because you are paying for this premium, you have a risk coverage and an investment. So that's why it's almost impossible to have a positive net present value or net future value. Yeah. And we will see, just as I have said, I will tell you what is how you can interpret that value. Then what happened so far till the period 56? Period 56 is in the year 14th. I think it's the last period of year 14th, if I'm not wrong. Okay, you have the actually paid premiums. I've told you they are surprisingly, they are a little bit lower than the ones indexed with 3%, because the indexation takes place actually with 2.97%. I haven't asked why yet, and to be honest, I think it's better not to ask, because maybe they just did an error and they need to correct it. If you look at the period 56, you will see a far larger amount. That is because for the 3 periods before period 56, I haven't paid the premium, and I paid with some penalties a lump sum in the period 56. Then you have the discount factor. You have the actual inflation rate for that year divided by 4 quarters. You will notice that mostly is above what we took. We took 0.75. However, okay, you have let's say in the period 21 it's similar, so in the year with period 1021 it's similar with 0.75. In the year with period 29 is 0.3, so it's actually lower. There are also years with deflation, so the years that include period 33 and period 37. And the idea is that at the period 56 you have already compound inflation of 59.4. If you go behind, you will see that at period 57 you had 52%, so that means that we are a little bit ahead with the real inflation as expected. But when you are deciding and you are comparing two policies, let's say that that's of less relevance, and we will see why exactly. Then we do okay, what's surprising is that okay, you have the positive cash flow one in the period 56. That would be the surrender value, which of course it's in 14th year it is 0.52%, 0.52, so or 52% of the end policies cash value only. I didn't put, of course, the 10% premium at the end that I'm getting, the bonus that I'm getting, because I'm not at the end yet. But I have another thing, another positive cash flow which is happening, which is resulting, it's like the gain from the reinvesting of because the company is collecting the money from the insured people like such as myself, and the money which they don't need to pay as insurance cover to the unfortunate ones that die or get into accidents and things like this, they invested in a very safe way, so mostly money market instruments or bonds and things like this, so deposits and things like this, and they are making a gain, and they are of course giving to the people also this gain, and that's something like a bonus which adds to the cash value at the end, or surrender value during the lifetime of the policy, and also will add to this bonus of 10%. So it's something positive, and it's very, very good. And if you are looking, we have till period 56, we have already minus 13,000. The things, okay, there are things that will happen between period 56 and period 80 till the end of the insurance policy. Basically the positive cash flow one, so the surrender value will go up to 1.1 so 1 actually, so to this 83,000, then I will get the 8,300. Of course, this gain will also be available and probably will increase in time, but I will also get extra inflation value here, so it's not really very easy to compare the current net present value or the current net future value with what we have modeled at the beginning. Now the conclusions. How to interpret all these numbers, because it might be confusing and it's not that straightforward as we have had it for the shares, where we said, okay, we have a positive net present value or net future value, what kind of discount factor we used. We either beat inflation or we beat our own target, and so on and so forth. So the NPV and net future values are negatives, as we have seen, for both the scenario which is covering the entire 20 years and also period to date, so these 56 periods. How you can interpret this? This is actually the cost you are paying for your insurance cover. In my case, I have a death clause, meaning that if I die, somebody is getting 249,000 monetary units. It's absolutely not relevant what kind of currency is that exactly. And you can interpret it that at least at the beginning, it's costing 14,000 in terms of net present value in order to get this 249,000 cover, yeah? And the idea is, when you select the policy, which one is better for you? If you get the same risk coverage, meaning that there is another company which is offering you a policy with the same 249,000, okay, it might have a premium which is fixed and is not increasing. You need to use the same discount factors for when evaluating both of them. You might have at the end a cash value which is higher or lower than this one. It doesn't really matter, because you can compare, you are taking this into consideration in this net present value. And if the risk coverage value, so let's say you are getting the same from two different policies, you are getting this 249,000 monetary units risk coverage, of course you are going to select the one which is giving you the smallest loss. Let's say if you have one with minus 14,000 and one with minus 10,000, you will pick the one with minus 10,000, because that's better for you. If you have different risk coverage, however, so let's say one is offering you 249,000 and another one is offering you 300,000, you can do this ratio between this net present value or net future value divided by coverage value, from my point of view, meaning that you would want to have the smallest number possible if you do it like this, or the largest one if you do it coverage value divided by net present value, meaning that for each dollar or euro in net present value, you want to get as much in negative net present value, you want to get as much coverage as possible. That would be it about the life insurance with the investment component, so with this cash value at the end. Of course, there are many other forms and in-betweens, and the idea is you need to just, as I have said, you need to read the contract and to try to put in this template that I gave you for evaluating your investment, to put all the relevant cash flows, and to try to somehow, if you have 2, 3 or even more policies, to find out which one is better for you, having in mind that your priority is the risk coverage, so somehow protecting your loved ones, your family, your close ones, and then the investment is relevant. So today the presentation from today was a little bit different, because it went a little bit farther than just basic wealth building and investing and so on and so forth. I hope you liked it. It's a little bit different, the topic, than what you are used to. And next time we are going to talk about also about let's say insurance, an insurance policy, but with the unit linked investment, and there the things are much more straightforward. We are looking at something which is almost in the area of, let's say, of the investment funds, but it looks like an investment plan, so it's something completely different. Than I don't need to use any disclaimer when we are talking about this next time. Just remember, if you like this video, to hit the like button, to comment if you have something to add, to share it if you think somebody might be interested about the topics that I'm debating here, and most important, and something which is costing you absolutely nothing, is to hit the subscribe button, and you will get regular updates when I'm posting videos, and you will not lose any videos of that I might post in the future. Also, below this video you have several links. First one, you can create an eToro account and trade there without a commission or a fee. We are talking about investments, no commission or no fee. It doesn't really matter how often you are trading, maybe you are just buying once something. It's a saving, so that's beneficial for you. Then you have 2 links from Amazon, 2 free audibles if you like audiobooks, or the Kindle program. I also use a Kindle, so I have a Kindle and I'm reading books. And last but not least, probably the most inconvenient for you, is my wish list with software and hardware equipment to improve the quality of my videos, webcam, laptop, the latest version of Microsoft Office, some video editing software better than what I already have, some light system for my apartment, a green screen, and all sorts of things in this direction, which will help me improve the quality of my video, and you will also benefit. But let's say from financial point of view is the most discouraging for you. The easiest is just to hit the subscribe button and to continue to watch my videos. Once again, my name is Alex Petrescu. Thank you for watching me, and I look forward to presenting to you next time. Just as I have said, life insurance with unit-linked investment plan. Goodbye.